Good evening and welcome to this evening's webinar where we're going to be discussing understanding your pension. Before we kick off, I will say that this evening is our third webinar in the series. So if you have missed the previous two, you might want to look at them and watch them back. They are available on our YouTube channel where you're watching this evening. So if any of the content this evening resonates with you and you want to check out, week one, we looked at planning and prioritizing your finances. And last Wednesday, we looked at saving and investing. So if they're relevant to you and you want to have a look, they are available to watch back. So this evening, as I said, we're going to look at understanding your pension. The reason why we're doing this is as a financial advisor, we do often talk to people and deal with people who kind of shy away from their pension. They have one, but they're shying away from it because they feel like they don't understand it. And they get a statement every year and it gets stuck in a drawer because mumbo jumbo. It is very important to understand your pension. And for one simple reason, it is one of the biggest assets you're ever going to have in life. For most people, their biggest asset is going to be their home. And second behind that, quite closely, by the time you retire, should be your pension. So understanding your pension, making sure you're getting the most out of it and making sure that it's well looked after is very important. As we go through this evening, we're going to start with how your pension works, the simple basics of it, of the workings of it. Then we're going to look at what is on your pension statement and understanding some of the lingo and the jargon that's on there and the figures that are on it. We're going to look at how much you need in retirement, which is something we frequently get asked. There's no one set answer to that, but there is some guidance we can give you. And then lastly, we're going to talk about what happens when you retire, because ultimately you're building a pension for when you're going to retire and need that income. And not everybody understands exactly how a pension works when it comes to retirement. So we're going to touch on that briefly as well. So look, hopefully we won't be holding you for too long as we move through all of those. First up, there are two forms of pension for most people. The first is the state pension. Okay, the Irish state will start paying you the old age pension once you turn 66. And it is based on the PRSI contributions that you've made over your working life. So if you have a full 40 years work with 52 weeks of the year getting paid, you will have a full set of PRSI contributions and you'll get the maximum state pension, which is about €14,400 a year. Okay, that pension is designed to keep you out of poverty in old age. It's not designed to give you any great lifestyle. So we do have some videos ourselves on our website and on the YouTube channel here on the importance of a pension and what it's to do. It's really important to understand that the state pension, if you have been used to a lifestyle greater than just avoiding poverty through your life, the state pension is not going to provide for everything that you need. And in that instance, you need the second form of a pension, which is a private pension. That tends to come in the form of two things, either an employer pension scheme, so a pension that you have in work, or a personal pension, which you've gone and set up yourself because there wasn't one in work or you decided not to join the one in work. Ultimately, with an employer pension, quite often you pay into it and your employer pays into it. So that's the benefit of it there. And you're also getting tax relief. With a personal pension, quite often you're paying into the pension yourself and then you're doing a tax return to claim the tax back on it. But there are various forms of both. So the basics for a pension, okay? As I said, the Irish state pension is based on your PRSI contributions over your working life and comes to 14,400 if you get the full state pension. If you don't have a full 40 years of PRSI contributions, there are ways you can make it up. If you think you fall into that bracket, it is important to reach out and talk to either the pension body themselves, the state's pension body, or talk to a pension broker or a financial advisor. You do get credit for various things, and you can also buy back PRSI contributions or make PRSI contributions later in life to make up for that. And there's also a number of other ways in which you can get a pension as a dependent of another, or there's the non-contributory state pension, which is a means-tested pension for those who essentially haven't worked through their lifetime for one reason or another. I will point out as well that there's the Irish state pension. If you've worked overseas, it's particularly common to see people who've spent a chunk of their career in the UK, for example. You would be entitled to a state pension there because you've been most likely paying the equivalent of PRSI in whatever country you were living in. And so there will be some form of state pension to come at the end. So it's important to factor that in. And again, to be in a position to go back and claim that. So again, if you need help, there's a wide variety of supports out there. Or usually, what I would say is the pension bodies in countries are usually pretty good for finding your records and telling you what you're entitled to. It is important to look at when we're looking at private pensions now. It is important to state, because I do get asked it quite a bit, if you go out and set up a private pension, it does not lessen your right to a state pension. The state pension is based on your PRSI contributions for your working life. It is not means tested. So if you have a private pension, they do not reduce the state pension that they're going to give you. The state pension is you get what you're entitled to. And that's, as I said, that's just based on the PRSI that you've put in. Just a question in there on the state pension. Can you defer the state pension? So that's a good question. You can. The official age to start getting the state pension is 66 years of age. But you can. There is now an ability to defer that. So if you say, I don't want this at 66, I'm going to wait till I'm 67, the payment goes up by, I think, about €20 a week. Again, you can defer it all the way out to age 70. And in those instances, for each year you give up the pension, the payment you will get every week once you do start to receive it goes up. What I will say is you need to be careful with that. When you defer it, generally the payback period, so that even with the increase in payment, the amount of time before you would actually have gotten what you've given up is significant. One of the pension providers talked through it at a recent conference, and you're well into your 80s before you actually get a payback on deferring your pension. So if you're giving up €14,000 at age 66, you give up the €14,400 for an extra €20 a week. You're in your mid 80s before you've actually earned that 14,000 that you've given up back in the extra payments. So on the face of it, yes, you can defer your state pension, but generally it's not advisable to do it because it doesn't particularly make financial sense. That's what I'll say there. The private pensions. So I mentioned this, I think, on each of the webinars the first 2 weeks. Your pension is essentially the best savings account you have at your disposal in Ireland. Okay, and the reason for that is it is a savings account. It's a long-term savings account whereby the money that goes into it is tax-free. So it goes in before you pay any income tax, USC, PRSI, etc. There's no tax on the gains that your pension makes. So your pension money gets invested, and because it's a long-term savings account, it gets invested, and there's no tax on the gains that those investments make. However, for the tax relief that Revenue are giving you on the way in and in there, they are setting rules on how you get that money back out. So ultimately, your pension is designed to support you through your old age. So therefore, the rules on you don't just get it all back in one lump sum and go off and spend it on a Ferrari or buy a house in some sunny country somewhere. This money has to be there and to be used to sustain you through your old age, as I said, once you stop working. So it is important to know that. As I said, we'll come on to later on how you draw down your pension, what the retirement benefit looks like on a pension pot. But it is important to know that while it remains your money, there are rules around how you get it back, and you can probably put it back at any stage, really. But there will be heavy taxes on it if you do it outside of the basic rules of a pension. So, in terms of how your pension works, okay, as I said, it's a long-term savings account or an investment account, really. You pay your money into it each month or each year. Some people do it weekly or monthly. Some people do it just a lump sum on an annual basis. It goes in. Your pension provider invests the money that's in there, and then your pension will continue to grow both from the money you put into it and from the investment return it's getting until you reach retirement. which is generally between 60 and 70 years of age. Okay. The state, people think about retirement as a set date. So I turn 65 or I turn 66 and I get my, I'm retired and I start getting my pension. That is true of the state pension. It kicks in on your 66th birthday and that's how it is. But with a personal, your private pension, be it employer or your own personal pension, it is a pot of money that is there for you to realize when you choose to. So ultimately what a private pension does is it gives you flexibility later in life. Whereby some people might choose to stop work altogether and retire early. If you want to do that at age 60, then you have 6 years before you'll receive the state pension. So you have to have a significant amount extra in your pension to support you through those 6 years. Or if you want to leave it later and not take it at 66 and you want to continue to work in some form or reduce your working week to 2 or 3 days a week, you're entirely free to do that, and your pension generally comes into those decisions once you get into your 60s and 70s. But generally speaking, are between the age with your private pension anytime from 60 to 70. I just see a question in there. Can you not get access to your pension from 50? So yes, you can. Generally speaking, it's between the age of 60 and 70. A PRSA, which is a form of personal pension, allows you to wait all the way to age 75 before you retire. And there is a possibility of getting access to your money from between the ages of 50 and 60 if you wish to. Generally, an employer scheme isn't going to let you access that money early. But in essentially what's called a pension bond is something that you can use to move your money into and then get access to. I will say your pension money shouldn't burn a hole in your pocket. So getting access to it in your 50s just to have access to this pot of money that's yours, as I mentioned just a minute ago, it's designed to support you in your old age. So it is important to try and leave that there for when you are going to retire and step back from work entirely. But yes, you can, to answer your question. I've an example on the side of the slide here. Just a really basic example of a pension. If you were paying into a pension, let's say €1,000 a month went into it. Okay, so €12,000 a year goes in. You do that for 25 years, and your investment provider gets you 4% per annum on the return. So that's including net of their fees and everything else. So maybe it's 5.5% investment return and they're charging 1.5%. So it nets back to 4% a year. After 25 years, you'd have over €500,000 in your pot. And what that looks like in retirement now, we will look at a little bit later, but it's a significant amount of money. And where I'm talking about at the start of it being important to understand your pension and how it works and what the benefits of it are, because it's going to be one of your biggest assets. I think you can see hopefully from that example that's why this snowballs very quickly. You can do the maths there. If it's €500 a month you're putting in, you're still at €250,000 after 25 years. So it's a significant sum of money and a significant asset for you and your family. Okay. Another question just in there on probably that last slide in terms of what is a good return on your pension? So a good question. There's no one right answer to that, is what I'd say. Generally speaking, we touched on investment risk last week in savings and investments. It is a scale of the investment products like a pension. There's a risk rating of 1 to 7. Okay, 1 being the most conservative, 7 being the most adventurous. Okay, your pension and the investment choices you make with your pension will be rated along that. Generally speaking, what I will say is the further you are from retirement, the higher up that scale you should be. So if you are aged 25 to 35 and you're intending to work till 65 or 70, okay, it's a 30-year investment horizon with your pension. You should be up really in the 5s and 6s in the most adventurous end of that scale, because what that scale is showing is not a risk of losing your money. It's a risk of, it's talking about volatility. It's how much that investment might move, increase in value or decrease in value in a given year. And ultimately, at the higher end of that scale, in funds and investment choices that are rated at a 5 and a 6, you are likely to get a higher return on average year on year over a 10, 20, 30-year period than you are in a 2 or a 3. So you should be up there. However, as you move through your working life and you get closer to retirement age, you should be moving back down that scale, because the amount of money in your pension is larger. So you do not want big spikes and big dips. And also, the closer you get, particularly the last 10 years, the less time you have to make up for poor performance within your pension. So you are going to start becoming more conservative with it. So what is a good return, being the original question? Probably 7% plus if you're in your 30s, in early 40s. As you move into your 50s, late 40s and 50s, that's probably coming back towards a 5 or 6% return. And then after that, it's really, look, this is off the top of my head, but maybe it's 3 to 5% in the final 10 years to retirement, because you really need to be more conservative the closer you get to retirement, more adventurous the further away you are. I hope that makes sense. Okay, so your pension statement. As I said, everybody who has a pension is likely to get one of these every year. If you don't, you need to check in with the pension company that is looking after your pension and make sure they have your current address and your details correct. But an awful lot of people take it, give it one look and then stick it in a drawer. Okay, it is important that you stick it in a drawer so that you have it to hand if you need it. Don't just bin it. But a couple of things that can hopefully help you start to make sense of it a little bit. Okay, some around the terminology. One of the first bits of information you'll see is your own personal information. So your name, your date of birth, when you started working or when you started the pension, etc. One of those details is the normal retirement age, or NRA. Okay, it's usually set at 65. You might start seeing it sneak up to 66 now to match the state pension. But what that is that is only a nominal date. That is not something that's set in stone. So if your normal retirement age on your pension statement is 65, that does not mean that you can't retire at 60 or you can't retire at 66 or 67. It is what they're assuming your retirement date is. So the figures within the statement are assuming that this is going to run until age 60, until your 65th birthday. You still have the flexibility I talked about earlier within most pensions. There might be some employer schemes that do set a date, but generally, again, there's some flexibility if you want to negotiate that one way or the other. Contributions is another thing you'll see probably all across your pension statement. Contributions are money going into your pension. So you have employee contributions or personal contributions, and you have employer contributions, which is what your employer is putting in for you. You will also probably see terms like regular contributions and single contributions. A regular contribution is something that's going in every week or every month. A single contribution is something that goes in once a year. So some people in some forms of work, quite often it's self-employed people, will do one lump sum into their pension, one single contribution a year at the end of the year when they know what they can afford, or when they're doing their tax return. Whereas a regular contribution is something, as I said, that's going in weekly and monthly. The total contributions, okay, can either be the total contributions in the year you're looking at, or it can be the total contributions that you've ever put in, so over the lifetime of it. Generally, some additional, I suppose, language in around total contributions will help you decipher which one it is or which one it isn't. But that's what you're looking at around contributions, okay? The other terms that you'll see there are current values and transfer values. So the current value of your pension is generally what the value of your pension is now. So all the money that you've put in, all the tax relief that you've gotten, all the money that your employer might have put into it, and the investment return and the charges paid back out of it to whoever's looking after your pension. The current value is what it is worth as of the date of the statement you're looking at. Okay. Transfer value is often something that's listed alongside the current value. a transfer for value will generally be the same as your current value. It's what the value would be if you transferred your pension today out into another arrangement. So it might be an old pension that you're taking out to your new employer, or it might be an old pension that you're taking out into your own name, which is also a possibility. But that's what a transfer value is referencing. If the transfer value is less than the current value, there's generally one of two reasons. One, that your employer can take back their contribution still. So that's usually in the first 2 years of your employment. If you're paying into an employer scheme and they're paying into it, generally, if you go into a business and leave within 2 years, they can take back the money that they've put into your pension. Not that you have, but they have. So that would obviously reduce the transfer value if you're disappearing out. And there may be the other thing that might pull down a transfer value is some fees that are in there for moving the pension to somebody else. Now, technically there is no fee for moving your pension from one provider to another. You're free to. It's your money, it's your asset, and they can't penalize you heavily for it. But sometimes within the arrangements, there are some fees to do that within the first couple of years after you set it up. So if you move your pension, transfer your pension within 3 years, there'll be some sort of penalty there. Those are the only two things that should really ever be pulling down the transfer value. There may be one or two other things I haven't thought of, but that's what we're looking at there. You'll also then see investment performance and charges, which are usually on the same page. Okay, this is sorry, I've just lost my train of thought there. Investment performance and charges. Sorry. So ultimately, the charges are what your pension provider are charging you for looking after, for the administration costs and for managing your money, so managing the investment side of it. And then the investment performance is the return that your money's getting. So what you generally say is the investment performance is what the pension provider is giving you and achieving for you, and the charges is what they're charging you to go and do that. Okay, it's important to understand them because I think I have an example later on as to the breakdown of a pension pot over its lifetime. What you put in is reasonably significant. The tax relief is as well, but so is the investment performance. It adds a huge amount to your pension, particularly if it's over a 25-year plus period. And the charges obviously take away from that. So it is important that you understand what the investment performance is like and what the charges are like, because if the performance is poor and the charges are high, you'd be free to transfer your pension to somewhere else and to a better provider to achieve better. A quick example there below. I don't know how well people can see it on the screen, but I'll just run through that very quickly. It's maybe a typical calculation that you'll see on the investment performance and charges page of your statement. Okay, you'll have the value of the value of the fund 12 months before, so what the year opened with, essentially. Okay, you'll have the total contributions paid, which is the money you've paid into it that year. That might be employee contributions paid, and there might be a separate section for employer contributions paid, but total contributions paid there is what has gone into this pension this year. So from the value it was at the outset of the year was 48,000, and the contributions have been 12. The fund should now sit at 60. There has been charges there of 624, which is going to reduce it a little bit, but there is an investment return of 3,000 euros, which is about 5%. So it means that your current value of your pension, the fund value as of the day of the statement, is 65,176 euros. So that is showing you basically the investment return versus the charges piece. Usually charges certainly wash their face quite comfortably. And the growth in your pension isn't just the contributions you're paying into it, but also the investment return. Okay, where this is an old pension that's no longer active, so you're no longer paying into it, you'll still have the fund value at the top, the fund value as of the 23rd of the 10th, 2023. You would have the total contribution paid would be zero. But the other two columns should be the same. The other two rows, at least, the fund-related charges that will still be being charged to you because they're still managing this money and investing it, and there should still be an investment return because, again, they're still managing this money and investing it for you. So there should still be growth on your pension every year, even if it's an old pension that you're no longer paying into. And that's very important for people to realize. In this day and age, most of us will move jobs and even change careers 2, 3, 4 times. If you end up with old pensions, it is important to keep track of them, and it's important to check in on them to see how they're performing. Because if it's been 5 years of employment and paying into a pension, and you've left that behind you, it will be a fairly significant sum when it comes to retirement in 10, 20, 25 years' time. So it's important to have the details of it. And then it is worth sitting down with somebody, a financial advisor, a broker, the pension provider themselves, and understanding how it's performing and making sure that it's been well looked after. And as I said, at the very least, that you have the details of it so that you can go back and claim it when you need to. Just a question through here is, what tax relief can you get on your pension? So when you're paying into a pension, that's where you get your tax relief. Okay, the tax relief depends on the income tax level that you're paying. So at the moment, if you're earning under 42,000 euros a year and you're paying into your pension, you'll get tax relief at 20% because that's the standard rate of tax. If you are earning over 42,000 euros a year, you're paying a marginal rate of tax, which is 40%. So you'll get tax relief of 40%. Okay, what that looks like for people is if there is 100 euros coming off, that you're putting 100 euros a month into your pension. Okay, there'll be 100 euros coming out at the top of your pay slip, heading off to your pension pot. But at the bottom of your pay slip, where it tells you your take-home pay, what you're actually getting paid, it would only have dropped by either 80 euros or 60 euros, dependent on what you're paying in, the difference being tax relief. So that's where it can become quite powerful. If you're a higher taxpayer on 60,000 euros a year and you pay 500 euros a month into your pension, there's 500 euros a month going into your pension and being invested, but your take-home pay has only dropped by 300 quid. So that's pretty nice investment return before the money even gets invested. And another one there, I don't know if I missed it. Can you lose your pension? So I guess that's around investment. I'm assuming you can lose your documents. If you do, if that's a question about what happens if you lose your pension documents. So like the old pensions I was just talking about. There are a few services out there, but generally what you need to do is get in contact with your old employer and say, this is my name, this is my date of birth, this is the dates I worked for you. I'm just looking for information on my pension, I've lost it. If you're talking around, can you lose your pension in terms of it gets invested poorly? Generally speaking, pensions is a heavily regulated industry, and while there are stories of people losing chunks or all of their pension pots, generally that is when they have drifted into unregulated investments with their pension. So if you have a pension with any of the big pension providers in Ireland, like Irish Life, Zurich, Aviva, Mercer, the big company schemes will be with the likes of Mercer and Aon and Willis Towers Watson. They're heavily regulated. So the investment risk, as I mentioned earlier, is about volatility in a year. It's about how much it's going to go up or down. Okay, the higher you want it to go up in a given year, the greater the chance it will fall by a significant amount. Losing all of your money or losing all of your pension is not generally something that will happen. As I said, it can and it has at times, but it's when you're in the unregulated pension space. A pension with the big pension providers is a heavily regulated industry, and they are invested for slow and steady gains. Okay, where are we at? 25 so we'll keep going for another few minutes here. So retirement planning. So what do I need in my pension? Okay, as I said, it's a question we get asked a lot. Quite a simple, straightforward goal for retirement is to try and look to retire onto 50% of your income. Okay, so where the state pension is 14,400 euros, if you get the full one, like I mentioned earlier, your employer pension, your personal pension, or a few of those, if you've ended up working 4 or 5 jobs, needs to provide you with the rest of that income. Okay. I have a couple of, so I suppose a really simple example here. If you're currently earning 50,000 euros a year, you want to retire on to 25,000, 50% of it, okay? If the state pension in the yellow box there is 14,400, then your private pension needs to provide you with €10,600 per annum to get you to your 25,000. Okay. To be getting about 10.5 grand from a pension every year, your pension pot needs to be about €265,000. Sounds like a huge amount of money. I have given a couple of examples there earlier. If you saved about €500 a month into your pension over 25 years and got a reasonable return at 4% per annum, you would be in around the €250,000 mark. How I worked that out is, generally speaking, what your private pension is going to pay you about 4% of the overall pot every year. So I took €10,600, divided it by 4%, and you get your €265,000, give or take a few quid. So if you want to run that very quickly and easily yourself, take your income, cut it in half. That's what you want to retire onto. Take €14,400 off that amount, because that's going to be your state pension if you have a full 40 years work. And then whatever's left there, divided by 4%, and that's the size your pension pot needs to be. And if you haven't started yet, or you're unsure on where you're going to get to or how you're going to get there, go and talk to somebody about it. Talk to me about it. I'd be delighted to talk to you. Talk to whoever you're comfortable talking to. It's important to have a grip on where you're at and where you're going to, where you're trying to get to, because as I said, as daunting as this sounds sometimes as to the amount you will need in your pension pot, broken down over 15, 25, 35 years, it is achievable for most people. Is there anything else in there on retirement? Yes, sorry. One point I'll make here is those figures all stack up if you're retiring from your work job at 66, because your state pension starts at 66. If you're hoping to retire early, okay, and that's a bit of a life goal that you would have for yourself, you will need a significant chunk more in your pension for a few reasons. One, your pension has to stretch for an extra 5 or 6 years if you want to retire at 60 or 61. But also, you won't get the state pension until you're 66. So you're going to be missing €14,400 a year from whatever date you retire until you turn to 66. So you actually need more out of your private pension in those early years if you're going to retire early. So your pot needs to be even bigger than it otherwise would. Those calculations that I've just worked through there are based on retiring at 66 when your state pension kicks in. All right. And last, but certainly not least, what happens at retirement? Okay, so understanding retirement benefits. You can have fantastic pension and all the rest of it. If you're not understanding how you're going to get your money back out, you'll either be disappointed or frustrated at the end of it. So, as I've said 100 times now, your state pension kicks in at 66. Okay, from your private pension, all right, your pension pot, generally speaking, you can get a retirement lump sum of 25%. You get a lump sum, tax-free lump sum of 25%, okay, of the pot. So up to €200,000, that's tax-free. So in a scenario where you have a pension pot of 400 grand at the end of it, at retirement, you get €100,000 tax-free straight into your hand, okay? The balance then, the remaining 75%, you have two options, all right? You can go out and buy an annuity, which is essentially a guaranteed income. That means handing in my quick example there, a pot of 400,000, get your lump sum of 100,000. The 300,000 you hand over to a life insurance company, essentially a pensions company, and they will guarantee you to pay you X amount of money for the rest of your life. Okay, it's a guaranteed income. It's a traditional way of thinking of pensions. Okay, it is, that annuity is paid to you once you buy it for as long as you live. Quite often, if you have a surviving spouse, you'll build into the calculations that if you were to pass away, your surviving spouse gets 50% of the payment. So if you were getting 10 grand a year, your spouse that survives you would continue to get 5,000 a year. Okay, but ultimately, that income dies with you. It's guaranteed for your life, but it finishes. So if you go out and buy an annuity, okay, the expectation is probably that you live at least 25 years after retirement. But if you pass away after 10 years, the annuity dies with you. So the life insurance pension company has made out probably pretty well out of it. If you live till 100, they've paid you well in excess of what you've paid them. Okay. The other option is called an approved retirement fund, and that is where you keep the 75%, the balance of your money, and you keep it invested with a pensions company. The money stays yours, okay, and you take approximately 4% out of that retirement fund. It's an ARF, approved retirement fund. You take about 4% back out of that investment account every year as your pension income. Okay. You are taking on, it's important to know you're taking on investment risk with that. So you take out your thing, and there are poor decisions made with it. You could ultimately bleed that account dry and end up with no pension, having started with a sizable one. But generally speaking, taking 4% a year, and there's an investment return coming back out of something similar, that retirement fund should last you quite well. And the important difference is with an improved retirement fund, when you pass away, the balance in the account passes to your estate. So it doesn't die with you. It's a significant asset that gets passed on to either in full to your surviving spouse, or where you're widowed, it would pass on to straight onto your estate to your kids or whoever else is going to inherit that estate. So where in today's world pension pots become sizable amounts of money that are hundreds of thousands of euros, quite often the approved retirement fund route is quite popular, because it maintains the money. If there's still a balance, it maintains the money for your family and for your estate when you pass away. That said, the guaranteed income of the annuity is still something that plenty of people opt for and like the idea of it. I just see one last question in there, and that's, what about public service pensions? So when I said there's two types, and it's private pension or state pension, there is a third, which is the public service pension. Now, I could do another hour and a half on public service pensions and only scratch the surface. The key difference around a public service pension is it is very much actually like the annuity we're looking at here. It's a guaranteed income for your life once you retire. It's based on your salary and your service generally. There are a number of different versions of the public service pension depending on when you started, but generally speaking, it's based on your salary and service. If you have a full 40 years service, okay, you'll retire on to about 50% of your salary, and at retirement you'll get a lump sum that's about 1.5 times. That is 1.5 times your salary. Okay, it's then done on a pro rata basis. So if you only had 20 years service in the public service, you would retire on to 25% of your salary, and your lump sum would be 3/4 of your finishing salary. So we could do it. Yeah, as I said, we could do an awful long time on public service. I suppose it is important to point out, if you do have a short service in public service, in a public service pension, if you do only have 20 years or 30 years instead of 40, what you can look at is an AVC, additional voluntary contribution. And in short, what that is it's almost like a side pot that is a private pension that you can pay into, and you can, I suppose, really almost treat like a private pension. You choose the pension provider, choose how it gets invested, and put additional money in there, get tax relief on what goes into it. And when you come to retire, you have your public service pension. You also have your AVC, which is an extra pot of money to give you a slightly higher lump sum and to give you a slightly higher income in retirement. So I think it's very important for, again, as people move around jobs quite a lot and move in and out of public service, if that's your main pension that you're relying on and you're not going to have worked 40 years fully, reach out and talk to somebody about an AVC. There will be someone in work, or you can go and just talk to a local broker to access one. And again, it's a private pension. The tax relief on it is excellent. The performance will be excellent. So I'd highly recommend looking at that. So I think that's everything. If there isn't any more questions. No. So look, 45 minutes. We'll call it there. Thank you very much for tuning in this evening. I hope you found it helpful. As always, if you have more questions, please do feel free to email us. Okay, my email is gareth@linksgroup.ie, or you can contact us through Instagram, LinkedIn, or any of our other social channels. And we'll be back next Wednesday with the final webinar in our series, which is around mortgages and specifically for first-time buyers and how to go and get a mortgage. So thank you and good evening.